Hi, my name is Oluwase Adeosun from ARM Investment Managers, and I'll be taking you through the macroeconomic and financial market updates for the month of June. Headline inflation declined to 17.93% in May for the second consecutive month due to the moderation in food inflation. Food inflation declined to 22.28% in May, likely due to base effects. However, we continue to see core inflation rise, printing at 13.15%, and remains pressured by pandemic-induced disruptions, insecurity, as well as weaker currency, which is impacting commodity prices. Purchasing Managers Index stood at 53.6 in June. Although the PMI reading in June was slightly lower than the 54.4 recorded in May, nonetheless, it still reflects improvement in business conditions. The PMI reading was underpinned by new orders reaching a 17-month high, slight moderation in output, and steep rise in purchase costs. The equities market closed with a loss of 1.38% in June. The quarter-to-date performance was a loss of 2.91%, whilst the year-to-date performance printed at a loss of 5.87%. The market was largely quiet, dominated by retail speculative investors who took profits on positions and reinvested in the relatively attractive fixed income yields. However, institutional investors remained cautious and continued to stay on the sidelines. The market's performance was impacted by losses recorded in the telecom sector, despite the gains recorded by the personal care, oil and gas, cement, and banking sectors respectively. Specifically, the performance drivers were Airtel, BUA, Presco, and Nascon, despite gains in stocks such as Nestle, Okomu Oil, Danksem, and Seplat. The fixed income market took a break from sell-offs in June after rising to a year-to-date peak towards the end of the previous month, as demands drove yields downwards, both at the primary and secondary markets for the federal government bonds and treasury bills. This was amidst the elevated inflation figure released and the tight system liquidity witnessed within the month, which would ordinarily have led to a bearish outcome. Average secondary market bond yields declined by 0.15% in June as a result of increased demand by investors for the instruments. However, average yields at secondary market for treasury bills rose by 0.94%. Average stop rate at the federal government bond auction declined to 13.32% in June, as subscription rates improved by almost 50%. Similarly, at the treasury bill primary auction, the stop rate on the one-year instrument declined to 9.15% from a peak of 9.75% earlier in May, as demand for the one-year instrument increased within the month. In the coming months, we expect to see improved activity in the equities market, particularly as we approach the earnings season. Investors are likely to react positively to stocks with impressive first-half financial scorecards. Also, we have noticed a moderation in fixed income yields, likely due to the anticipated bond maturity next month. However, if the decline in yields persists, this could result in increased participation by investors in the equities market. The buy interest witnessed in the fixed income market in June is expected to continue in the coming months, given the expectation of increased liquidity from the bond maturity, coupons, treasury bill, and OMO maturities in July, as investors seek to reinvest proceeds. A further but moderate decline in yields is therefore anticipated from the increased demand. A quick recap of what we've discussed so far. Inflation declined for the second consecutive month. Although Purchasing Managers Index slightly moderated, it still signaled business expansion. The stock market again remained in the loss territory. Yields in the fixed income market declined due to increased buying interest by investors. I hope this has been insightful. Should you have any questions, please do not hesitate to contact your relationship manager or our customer care representatives. And remember, we remain invested in your tomorrow.